I buy gold not because I hope it's going to go up, but rather because I'm afraid it's going to go up a lot. I don't want my standard of living to change. I don't want the gold price to go to $8,000. I don't want the whole set of circumstances that would cause that to occur.
Right.
I'm afraid it's going to, as opposed to when I talk to people here on the floor, and they say they can't wait for $5,000 gold.
I think the net result actually is an inflationary feature to save the system, which in a perverse way could actually be good for stocks over the next couple of years, depending on the nature of the pivot and whether we just have a rate cut followed by QE to the moon. But ultimately, I see an inflationary endgame, which is not the end of the world, but it certainly changes the dynamics.
In recent months, the United States has witnessed a decline in inflation rates. However, Federal Reserve Chair Jerome Powell remains cautious, emphasizing the necessity for heightened confidence before contemplating interest rate reductions. The nation's escalating debt crisis, characterized by Powell as an unsustainable fiscal path, currently stands at over $34 trillion. Projections from the Congressional Budget Office suggest a concerning 181% increase over the next 30 years, amounting to a staggering $144 trillion. This presents a different narrative from the mainstream focus inside the United States, where the majority of attention has been on when the Federal Reserve will cut interest rates. Renowned analyst Matthew Piepenburg argues that the Federal Reserve's handling of these crises encompasses addressing immediate financial concerns and managing the narrative surrounding them. Kristalina Georgieva, managing director of the International Monetary Fund, has expressed concerns about the challenging fiscal year ahead, emphasizing fiscal policy's need to rebuild buffers and address accumulated debt in various countries. Matthew observes a pattern of accumulating further debt and devaluing currency, prompting individuals to consider gold as a hedge against potential economic instability. Rick Rule is also concerned about potential economic slowdowns, suggesting that an increase in nominal interest rates could trigger such an event. He expresses that his decision to invest in gold is not driven by hopes for price appreciation, but rather by the fear that its value might substantially increase. This is because gold is considered short-term volatility, experiencing violent price swings during small, isolated periods. For instance, in 2023, it ended at $2,078.40 per ounce with a 15% annual return, outpacing other investments. However, its current price of $2,026.62 per ounce reflects a decline, attributed to stronger U.S. economic data and Federal Reserve signals hinting at fewer interest rate cuts, driving up the dollar and bond yields. We will present clips from Matthew Piepenburg and Rick Rule's interview. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
The Fed does a really good job because on that trilogy of, debt crisis, credit crisis, currency crisis, then is a centralization crisis. And part of that centralization is messaging. This sounds conspiracy theory, but messaging control, what's not discussed, what's omitted from the daily dialogue and the mainstream media or even the alternate media. Well, what's omitted are these hard facts on the ground. Let's just ignore them. Let's be calm and carry on. As it builds resentment, that's hard to quantify, mistrust, whether it's on Main Street, whether it's with the world reserve currency, whether it's with weaponizing, whatever debate you pick. It could be geopolitics, could be crypto, could be currencies, but there's a growing distrust that's somewhat palpable. But can we cut spending? Can we cut entitlements? Can we cut the military? Can we do it like with a chainsaw in the West? I don't think so. So we'll postpone, go further and further into debt, and debase the currency. And Rick has always said, I don't want to see gold. I buy gold because I'm afraid it's going to go up. But I think deep down, Rick, you know it's going to, well, you don't know. I'm not going to say you know, but you feel like it very well could go up. And it's not so it makes you richer. It keeps you from getting poorer. I don't know. That's
my motivation. That's exactly correct. I buy gold not because I hope it's going to go up, but rather because I'm afraid it's going to go up a lot. Right. And that whole, I'm a very happy 70-year-old fat rich guy. I don't want my standard of living to change. I don't want the gold price to go to $8,000. I don't want the whole set of circumstances that would cause that to occur.
Right.
I'm afraid it's going to, as opposed to when I talk to people here on the floor, and they say they can't wait for $5,000 gold.
So when you have a debt crisis, that leads to a sovereign bond crisis, which then leads to a currency crisis. And they're going to have to, in my opinion, monetize that debt in some way. There has to be demand. If that's not natural demand, it has to come from something. I think that will come from the central bank. They will debase the currency to save the system, and that will be inherently inflationary. So I think right now, as we're all talking deflation and Powell's won the war and the victory dance is being made, I think the net result actually is an inflationary feature to save the system, which in a perverse way could actually be good for stocks over the next couple of years, depending on the nature of the pivot and whether we just have a rate cut followed by QE to the moon. But ultimately, I see an inflationary endgame, which is not the end of the world, but it certainly changes the dynamics.
But I sort of believe that we haven't had a real economic slowdown for a long time. And perhaps as a delayed consequence of an increase in at least nominal interest rates, it wouldn't surprise me to see an economic slowdown. An economic slowdown, we're going to have a very strong market for commodities simply because of global population growth, an increase in living standards among the poorest third of humanity, and the fact that society has underinvested in extractive industries for 30 years. Meaning, I think that commodity supplies are going to be tight 5 to 7 years out, irrespective of whether we have a recession. If we do have a recession, the impact of that will be muted because you can have declining supplies if you have declining demand, and prices don't move. I realize that's a convoluted answer, but it's the best answer that I can give. I have zero doubt that we're going to have supply shortages in conventional energy, in oil and gas, not because of demographics, but rather because of an underinvestment in sustaining capital by the industry, including state-owned industries, of $1 billion a day. I think that we're going to have supply shortages in base metals simply, again, because we haven't been investing in productive capacity, and the permitting timelines are extraordinary. Whether or not prices go higher or lower and share prices respond well really depends on the strength of the general economy.
In the last few weeks, former Treasury Secretary Robert Rubin warned on Bloomberg TV that the U.S. economy is in a terrible place, echoing concerns raised by Black Swan author Nassim Nicholas Taleb, who cautioned that a debt spiral is like a death spiral. Rick Rule expresses concerns about potential market volatility and the likelihood of a Black Swan event triggering a crisis, mainly due to the significant amount of junk corporate debt held within exchange-traded funds. Investors are increasingly embracing high-yield funds, with record inflows of $11.9 billion into ETFs tracking junk bonds in November. But if panic or credit concerns spark a sell-off, ETF managers may struggle to liquidate, risking a severe market downturn. While Rick Rule doesn't foresee a complete market collapse due to the ability to inject synthetic liquidity, he emphasizes the potential for continued currency debasement to sustain the existing financial system, albeit at the risk of eventual political and social upheaval. Matthew agrees with Rick, emphasizing the inevitability of extremely negative real interest rates within the next 6 to 10 years, irrespective of official inflation measurements like the Consumer Price Index, CPI. This trend will result in more currency debasement and reduced purchasing power of fiat currency, particularly impacting the middle class and potentially sparking social unrest. Let's get back to the interview.
I see a future in the next 6 to 10 years of extreme negative real rates, regardless of what the BLS tells us what the CPI scale is, which is an open fiction on Wall Street, but that's not a conspiracy theory. And this was a conversation with Russell Napier years ago, before inflation was the topic du jour, who was a staunch deflationist before he not because I changed my mind, but he saw it. Matt, every debt soak regime needs negative real rates to get themselves out of debt. So we're gonna have negative real rates, regardless of what the official CPI scale says. That means more currency debasement. So we can continue this charade at the expense of the purchasing power of our currency, the value of the fiat currency. And that will ultimately affect the middle class far more than, even though it hurts and annoys us, it debilitates them. And so that social unrest component of this comedy we're playing with our debt levels, our credit markets, and our currency, that social unrest is hard to predict and quantify and objectively determine what is unrest. Is it January 6th? Is it, identity politics? Is it the rise of X or Y leader? Will it be clean before then? I don't think we're going to see pitchforks. We could just have a very dumbed down population that's told to be afraid of something else while we continue this ridiculous credit expansion that we can't afford.
I think there's a possibility, maybe not a probability, I think there's a possibility of a liquidity crisis. I think there's a possibility, given how much volatility we'll face, that there is a black swan out there that causes a liquidity crisis. If it were going to happen, my suspicion, the thing that makes me most nervous about, by definition, you don't see a black swan, right? But the thing that makes me most nervous, junk corporate debt, and the holdings of several $1 trillion in junk corporate debt in ETFs. where the superstructure is very liquid and the underlying assets are illiquid, if you had a circumstance where there was concern among the population in credit quality, the junk bonds started to sell off, people started redeeming ETFs, the manager won't be able to sell the underlying security. And that would be truly, truly, truly ugly. And I'm not sure I think that that's a probability, but it's a strong enough possibility that I'm chased all the way out of the high yield market, even for credits that I know and like.
Because that black or gray swan, because a black swan you can't predict, there are so many potential needles at this debt balloon. What will be the trigger or the predominant needle 6-10 years out? It's a mug's game to predict, but the vulnerability and the risk is so heightened right now, and so out of sight, out of mind, and so politically ignored and media ignored. Again, I don't think we'll have a default. It's impossible, because we can always monetize that with synthetic liquidity. And even if there is a liquidity crisis to the nature that Rick's discussed, we'll find a way to come up with artificial liquidity. But again, this goes to the original point. You will save the quote-unquote rotten system by debasing the currency until there is some type of revolutionary event in politics.
While gold is currently undergoing a period of consolidation between $2,000 and $2,050 per ounce, this could set the stage for another significant rally if the Fed proceeds with the anticipated rate cuts in the spring. How has recent economic uncertainty impacted the demand for gold as a hedge against potential economic instability? Share your thoughts in the comment section below. If you find this video informative, remember to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.